Yesterday, you said in a speech that it is time to remove the accommodation we have been providing. That means marching up to neutral and looking at whether we need to go over neutral to tighten a little bit, restrict the economy to ensure that inflation comes back down. My first thought was, what song are we marching to? But my second thought is, what is neutral? How high do you have to go and how fast do you have to get there?
Well, let me say that the song, and I'm picking up on what you said, but the song we're marching to is that we have a dual mandate: price stability and full employment. And of course, with the labor market so strong, inflation is the top of everyone's mind. And so then it's about removing that accommodation. And if you think about estimates of the neutral rate, and there are a wide range of estimates, the confidence we have in any specific estimate is not very high, but I'll just use what I think more or less is a consensus estimate, which is that the real neutral rate is 50 basis points, 0.5. And expected inflation at our target is 2% on average. So that gives you a nominal neutral of 2.5. So if you think the nominal neutral is 2.5, then marching towards neutral, as you would say, or I did say, is getting the policy rate to 2.5 at least, and then being restrictive would be moving it above that. But of course, the neutral rate of interest is a concept. It's a star variable, as we call it, and they're easier to talk about theoretically than they are to measure. But the measurement we have suggests that, to answer your question specifically, 2.5 is sort of the neutral nominal rate that we would be aiming for. And then if we went above that, that would be restricting the economy, not just removing the accommodation.
Well, how far above it do you think you have to go? And again, how fast do you have to get there?
So let's start with how far above it we need to go. I think, my own view is that some increase in the policy rate above neutral is likely to be required, but that's down the road in 2023. And so right now, I don't think we need to be so decisional on what that looks like. We just need to be recognizing that if inflation comes down because our policy rates adjustments are affecting inflation, because the factors that have also been pushing it up, supply chain disruptions, the weak recovery of labor supply, to get labor force participation to come back, the general settling of the economy, people start buying services and not just goods, then we might find that just a little restrictive is just right. If, of course, those factors don't materialize and inflation keeps moving up, then we're going to have to be a little more restrictive. But I don't think it's necessary to call that today, just to be assuring the American people that we're prepared to do whatever it takes to ensure that we get price stability, which clearly no one thinks we have right now.